You face a classic choice. Do you want heavy cash flow today, or do you want to build a massive compounding wealth machine for tomorrow? It is easy to look at a stock paying a 10% dividend and treat it like a high-interest savings account. We see a double-digit yield and assume it operates just like cash in the bank, only better. But unlike a bank, stock dividends are not guaranteed. Chasing the absolute highest yield on the board is frequently the fastest way to wipe out your initial investment entirely. To understand why, we are going to look under the hood of the yield trap. We will identify the specific metrics that determine a company's financial health and show exactly why sacrificing a high payout today generates significantly more wealth later. In the stock market, an unusually high dividend yield is rarely a reward for smart investing. It is almost always a warning siren of corporate distress. To see how a trap forms, look at the math. A company's dividend yield is calculated by taking the annual dividend paid and dividing it by the current share price. That creates the denominator effect. If a stock is trading at $100 and pays $5 a year, the yield is 5%. But if market panic cuts that share price in half to $50, the yield automatically spikes to 10%. Even though the payout hasn't changed. This is where investors get caught. You might see that 10% yield, notice it is double the sector average, and hit buy, thinking you are locking in a massive return. But you have to ask why the share price dropped in the first place. The market is pricing in reality, declining revenues, rising debt, or an upcoming corporate restructuring. The business is in trouble, and a dividend cut is almost certainly on the way. When management finally slashes the dividend to save cash, the remaining investors panic. The stock sells off aggressively, and the share price plummets even further. Capturing a few months of a high cash payout is entirely pointless if the underlying stock price crashes and takes your initial capital down with it. To identify an unsustainable dividend before you buy, you only need to look at one metric, the dividend payout ratio. This compares the company's total earnings against the amount it distributes to shareholders. You find it by dividing the annual dividend per share by the annual earnings per share. A healthy business keeps the majority of its profits to grow operations and pays out a reasonable fraction to investors. The red flags appear when that payout ratio climbs past 80 to 100%. At that level, the company is distributing nearly every dollar it earns, leaving zero margin for error if revenues dip. To maintain a ratio over 100%, the company has to fund its dividend by taking on high-interest debt, or by gutting the internal research and development needed to stay competitive. You get a slightly higher income check this quarter, but the company sacrifices its future survival to write it. A dividend suspension becomes a mathematical certainty. The direct counter-strategy to chasing yield is dividend growth. And the purest expression of that strategy lies in a group of companies known as the S&P 500 Dividend Aristocrats. The criteria for this group is strict. To qualify, a company must be in the S&P 500 and have increased its base dividend payout every single year for at least 25 consecutive years. That quarter-century track record means these companies have survived the dot-com bust, the 2008 financial crisis, and global pandemics, all while consistently putting more cash into their shareholders' pockets. They are rarely flashy tech startups. They are legacy, defensive businesses selling everyday essentials, groceries, toothpaste, and household goods that consumers buy regardless of the economic climate. The trade-off is that you have to accept a much lower initial yield. You might only get 2% on day one, which requires intense patience. This chart compares two approaches over a 15-year timeline. The flat line represents a static, high-yield stock that eventually cuts its payout. The upward curve represents yield on cost. Because an aristocrat raises its dividend every year, your payout grows against your fixed initial purchase price. A 2% yield today can mathematically grow into an 8 or 10% yield on your original cash a decade from now. Aristocrats lack the immediate thrill of a double-digit yield, but their combination of steady capital appreciation and compounding income acts as the ultimate long-term hedge against inflation. The strategy you choose also dictates how much the IRS takes from your returns. Not all dividend income is treated equally. To receive favorable tax treatment, a domestic dividend must be classified as qualified. This requires holding the stock for more than 61 days during a specific window around the ex-dividend date. If you meet that holding requirement, your dividends are taxed at the long-term capital gains rate. Depending on your income, that rate could be 15% or even 0, preserving massive amounts of your wealth. Compare that to ordinary dividends. If you bounce from stock to stock chasing high yields or buy exotic covered call funds, your payouts are taxed at your highest regular income bracket, exactly like your salary. The U.S. tax code mathematically penalizes impatient investors who trade frequently for yield, while aggressively rewarding disciplined buy-and-hold dividend growth. Evaluating these trade-offs brings us to the only metric that truly measures investing success: total return. This is the combination of your capital appreciation and your reinvested dividends. To maximize total return, investors use a DRIP, a dividend reinvestment plan. Instead of taking the cash, your payouts automatically buy more shares of the underlying asset. Those new shares generate their own dividends next quarter, which buy even more shares. It creates an accelerating compounding snowball without any additional effort. If your high-yield stock requires you to watch your principal investment slowly burn away just to maintain the payout, your total return goes negative. You aren't generating income, you are actively destroying your wealth. This matrix shows how to match your personal timeline and risk tolerance to the correct dividend strategy. The vertical axis measures your need for income, and the horizontal axis your time horizon. If you have 10 or more years until retirement, your strategy belongs in the future income decades horizon quadrant using Dividend Aristocrats and dividend growth ETFs. Avoid the high yield trap. Prioritize compounding DRIPs to protect purchasing power against inflation over the long haul. Conversely, retirees needing immediate cash for living expenses belong in the short-term horizon quadrant, utilizing quality-filtered high-yield and sector-balanced portfolios. Because you require a higher current yield, you must aggressively screen for safe payout ratios and strong free cash flow, rather than blindly sorting a stock screener by the highest percentage. Successful dividend investing is never about finding the absolute highest number on a page. It is about matching sustainable corporate health to your specific timeline so that your income outlives you.